What's going on, guys? So today I wanted to go over the mortgage crisis and what the heck is going on. Because what's really happening right now is basically what we're supposed to do is we're supposed to make a bunch of money, and when times are good, we save it up for when there's an opportunity, and when prices go down and economic situations aren't so great, that's when all the opportunities are, and we buy them up and get a good deal. But right now, nobody has jobs, they can't make their mortgage payment or rent, and the banks are kind of chirping and going, I don't really like this situation, and I don't like that you don't have a job, and I ain't gonna lend you any money so you can go get yourself a deal. So it's kind of a tough and weird situation. So we're gonna go over a couple things. Number one, we're gonna go over what is going on and what it all means. Number two, we're gonna go over the impact of these new changes. And number three, what I suggest you should do during all of this craziness. So stick around to get all the details. See you on the other side. Okay, so let's go over what's going on here. So this is a very interesting situation where we're having this economic downturn and nobody can go make any money because we're supposed to stay home and stay safe, which I love that the community is doing that, but it's making it really difficult for us people who are trying to find deals and purchase a home and get ourselves a loan because there is so much going on in the mortgage industry right now. And let's break it down. So basically what happened was the Fed dropped their rate to 0 to stimulate the economy. Now what happened was a lot of people basically went to their lender and said, hey, I would like to refinance, I would like to get a better interest rate, which basically sucked all the reserves out of a lot of lenders' bank accounts, giving them not much to lend out anymore. And now people are going, oh, you know what? The economy is not doing so great. This would be a great time to buy because you want to buy on the low, not on the high, but they're not lending any money. They're basically strapping down and saying, whoa. Yeah, you don't have a job and not quite sure if you're going to be able to pay that mortgage payment. We don't even have that much money we want to lend out. So yeah, we're not going to give you any money. But really, honestly, can you blame them? They don't have that much reserves. They don't want to create a situation where, the government's going to have to bail them out. And it's just probably not the best situation for them. So usually in these situations, banks are usually going to have the best and lowest interest rates. But I've always suggested this in the past, and better yet now, it's probably best that if you are looking to take advantage of these opportunities coming up, that you most likely work with a lender who has creative solutions and not such strict guidelines like some of these major banks out there. The Mortgage Credit Availability Index just dropped by 16%. So what does that mean? That basically means your chance of getting a loan has just dropped by 16%. So once again, working with the bank might be a little bit difficult now, seeing that they're really strapping down with what money they lend out and who they lend it out to. And what really sucks about this is for some of those people out there that still have a job and they're seeing that there's opportunity in the market and there's a great time to buy, which is actually gonna help stimulate the market and maybe help that seller who needs to sell their place liquidate it so they can pay for the other things that they got going on in their life. The banks and the mortgage industry is making it really difficult for us to help the economy, borrow that money, and keep money moving forward. So it's kind of a tough situation. So just another example of what some of these mortgage lenders are doing is VOE, verification of employment on the last day of closing. So sometimes you'll already be in escrow, maybe even before all this craziness happened. You get towards the end, and on the last day, if you got furloughed or laid off, that lender's gonna give your job a call and be like, hey, just wanted to check, is Patrick still working there? What? He got furloughed? Oh, that's not good. Boom, denied. You can't get that home. And these are the new strict rules that are being put in place that's really making this really difficult for this economy to move forward. But really, can you blame lenders for being so strict on lending out money? I mean, imagine this situation. You buy a house, you're in escrow, you're towards the end, the loan goes through, they didn't check if you still have your job, you end up losing your job, you can't make your first payment, you call up your lender like, hey, guess what? Yeah, appreciate you giving me that loan. I can't make my payment. I just lost my job. And then the lender goes, hey, no problem. What we're gonna do is we're gonna set you up on a payment plan that's gonna screw you over so that you go into foreclosure and have to sell your house for near to nothing. You see, guys, you can understand why the mortgage industry is actually being a little bit more strict on the money that they lend out. We're trying to avoid the bubble that we had in 2008, my people. So basically, with that forbearance stuff, check out my other video where I go over the crap that's being pushed out when it comes to not being able to pay your mortgage payment and what some of the options these servicers are giving you. So make sure you check those out. So basically what we got going on here is an issue of simple economy, supply and demand. Because right now, what we've done is we've decreased the amount of buyers because these banks aren't giving out any money for people to go buy houses. So now we have less buyers and more sellers, and in a situation where they need to liquidate, they really need to sell. What are they going to do? They got no one to buy the house. They're just going to start dropping their price, which means that the actual values of homes are going to start dropping now. And furthermore, if there starts to be more short sales and foreclosures, that's just going to further bring down that price of that home. So it's kind of a sticky situation. Now, I don't want to say the sky is falling by any means. I'm really hoping that in the next 1 to 2 months that the mortgage industry will get their stuff together and help stimulate the economy by allowing regular Joe Schmoes to borrow money opposed to just the rich and famous. So if that does happen, we should be okay. But these are things that are what's going on in the mortgage industry that you may or may not be aware of. So I wanted to give you a heads up. Now, an interesting statistic is that 43% of buyers will put 20% down or more. And those people won't have as much issues when it comes to getting a loan because there's less risk and when you're putting that amount down. Now, for the rest of us, for that 57% of us who are putting less than 20%, so that's, either a 3.5% FHA loan or 10% conventional, what have you, those are the ones that are having real issues when it comes to buying a house and just furthermore dwindling down the actual buyer pool, which isn't good for really anyone. It's good for you if you are looking for a house and you do qualify and you find yourself a good lender, because you now are competing against less people, and most likely with what's going on, we are going to see a dip in prices. So there will be deals to be had, and you're not going to have to compete against probably about half of those 57%. And furthermore, a lot of these people who are going to be using those conventional or FHA 3.5% down, a lot of those people lost their jobs, furthermore can't get the loan, which means you'll be competing against less people if you can get qualified for a loan. So if you can, it might be a good time to really start being aggressively shopping. So let's go into what can you do with this craziness happening. Well, there are 2 trains of thought. The first one is you need to be on one side of the fence. You either A, think that the government is going to stop printing money and we are going to see a deflation period, or 2, they are going to continue to print money and give out more stimulus checks and forbearance and things of this nature, and we are going to see inflation happen in our economy. Now, if you are on that side of the fence of deflation, I would highly suggest that you go invest in basically gold or Bitcoin. But if you're on the other side of the fence of inflation, these are the things I would suggest you do. So what you're going to want to do is get into assets. So the 3 ways you can get into assets are, now keep in mind, you only want to go this route if you truly believe that our government is going to keep printing money and create inflation, meaning prices are still going to go up, money's still going to be printed, and that's really important to make sure that that is your train of thought when you move forward with one of these 3 options. So if you think in the next 15 years, prices are going to be going up, home prices are going to be going up, you are in the thought of inflation. If you think that it's the opposite, in the next 10 to 15 years, home prices are going to be going down, then go buy some Bitcoin. That's all I could really say. I'm not anti-Bitcoin or what have you. I just don't understand that stuff. I know real estate. That's what I mess with. So the first thing that I would do, easiest way to get into assets, is index funds and dollar cost averaging, basically buying on red days. So what is an index fund? Well, this is a sample of an index fund. There's a bunch of different types of index funds. You can go out, do your research to see which ones you want to invest in. But basically what it is, you're not investing in just one stock. You're hedging your bets and really spreading the risk out by investing in lots of smaller and mid-cap companies, but also the big dogs, Apple, Amazon, Alphabet, which owns Google and those companies, Microsoft Corp, Facebook. So you get a piece of everything and not putting all the risk and all your beans all in one basket. This spreads the risk. And what you're going to want to do is just chip in every single month, figure out what you can save and what you can invest in the index fund on a consistent basis, because all it's trying to do is what we like to call match the market. And the theory behind that is, instead of buying a stock and then seeing it go up, seeing it go down, and having to buy and sell and stress, and is you're looking for the long haul, that the index fund is simply going to match the market. So you can see an ongoing trend here over 100 years. This is the Dow Jones, I believe, which is basically all of the companies and how the market's doing, generally speaking, is that it just goes up. So you're looking to go for the long haul. Now, what I would suggest is if you are trying to get index funds, there's a couple like awesome robo-advisors and tech companies out there that have very little to no cost to get started in regards to commissions and fees and things of that nature. There's M1 Finance, and if you're looking for something that's really set it and forget it, there's Betterment, where literally you can set up how much you actually want to invest. You can figure out how aggressive you want to be. And another traditional option is Vanguard. There's also Charles Schwab, Fidelity. There's a couple different options. I'm more of a tech head, so I like the Betterment and M1 option. It just is simple, set and forget it. The websites are really clean, but that's just my personal preference. You're gonna wanna do this on a monthly basis and do it regularly, so you're just buying in, and this is for the long haul. Once again, 10, 15 years, you see stocks going up, prices going up. That's the best way for you to take the money that you do have and make sure that you're leveraging it so that you can make money on it, and maybe even later use that cash to buy a house later and just kind of move your investments around. I'm not a financial advisor. I'm just somebody who likes to invest and move my money around and make money on my money. So that is the easiest way for you to get into assets in these tough times. The second thing I would do is, if you can get a loan, especially with these tough times, it would be best for you to buy real estate. I can't imagine the market, especially out here in Hawaii, going down any more than 4 to 6%. And without looking to my crystal ball, based on 30 years of data, it will recover, it will go up, as long as you're not trying to flip houses. Now is not the time to flip houses. Now, the third thing I would suggest doing, and a little bit riskier but very easy to do, is buying what I like to call bounce back stocks. Now, what I would do is, right now with the stock market being so volatile and just going up and down, there are opportunities to purchase deals, and it's as easy as a click of a button. Now, that can be good and it can be bad, because you can quickly and easily lose money, opposed to when you purchase a house, it's kind of a process. But there is some opportunity in the market if you purchase good stocks. And when I say good stocks, I usually like to focus on companies that I know that are still going to be here in the next 20 to 30 years. Coca-Cola, Apple, Amazon, some of these stocks that we can see in the stock market have discounted because of the craziness of this virus, and you can actually buy into it. It will bounce back because it is a strong company, and then you can take that money and once again invested in real estate. So these are the 3 things that I would suggest doing during this crisis. If you guys have any questions, put them in the comments down below. I would like to know, what are you guys doing? Of those 3, which one do you like the most? Are any of you guys gonna actually be doing it? And is there any stocks that you're looking at to purchase in to hopefully help you purchase your real estate later down the line? Anyways, guys, that's it for now. Again, I'm Patrick with PatrickLongleyRealty.com. You guys stay strong and healthy, and I'll talk to you soon. Aloha.